When looking to build an investment portfolio that can set you up for financial independence and retirement if you choose to take that route, whether early in life or later in life, there are many different paths you can take. One of them is probably the most simple path, which is just investing in a broadly diversified index fund that charges low fees and dollar cost averaging in over time. And then when you get to a point where it meets a certain threshold, many people use the 4% rule, which is when your portfolio is about 25 times your expected living expenses in retirement, or you could say you live off of 4% of your portfolio each year in retirement. You just then liquidate 4% of your portfolio each year once you retire, and you trust that market performance over time is going to be strong enough and consistent enough to replace those lost shares that you cannibalize each year to sustain your living expenses throughout the rest of your life. Now that's a fine approach, I suppose, for some. However, it makes a big assumption that stock market price performance is not only going to be strong enough on average, but consistent enough over periods of time that you don't cannibalize your portfolio and ruin your retirement. And I think this is an important thing to keep in mind. It makes me think of the story about never forgetting the 6-foot-tall man who drowned while crossing the river that was 4 feet deep on average. And really what that means is that, okay, there are periods where the stream or the river was very shallow and he was able to cross no problem, but then there was an extended period that was so deep that he couldn't make it across and he ended up drowning. And that goes the same when you're investing in an index fund like this, because you're making a big assumption that there's not going to be a prolonged period of market bearishness, of market weakness. And because if there is, even if the aggregate performance over the next, say, 30, 40 years or however long your retirement is going to be is still strong or in line with historic averages of, say, 9, 10, 11, 12% annualized returns, you may get to a point where you cannibalize so much of your portfolio that it messes up your entire calculation. And so that's the big risk with taking that otherwise simple approach. And aside from that, there's just the psychological pain of seeing, hey, maybe my portfolio dropped 20% in April when Trump announced the Liberation Day tariffs, and now I have to sell a chunk of it to fund my living expenses. Maybe that's when your timing comes in and you just have to sell after such a big loss. That can cause you to not sleep as well at night because you're stressing about market chaos and market volatility. The other path, which is the one that I personally subscribe to, is living off of dividends. And that's because you don't have to be dependent on the market's whims. You simply need your underlying holdings in funds or individual stocks to consistently generate profits and pay out dividends year after year, and ideally grow those dividends either through organic dividend hikes or through you investing some of your excess dividends that you don't need for living expenses to keep up with the corrosive power of inflation year after year after year. And so that's another approach. And the reason I think that approach is better is that you're less exposed and dependent on the volatility and the uncertainty of the market, and instead can just count on dividends. And while dividends certainly can get cut, they are much less fickle and they're entirely tied to the underlying fundamentals of the business, as opposed to just being dependent on market sentiment and crazy things that go on. Additionally, with dividend stocks, you're investing in profitable companies, and you can look at their track record and ensure you're investing in a truly profitable business that has a durable and defensive business model and a strong balance sheet. Whereas when you're just investing in the broader market, you're going to be typically investing most of your money into high-priced, high-flying stocks that are in vogue at the time and may not necessarily have strong underlying fundamentals underpinning their stock price performance. So again, you're really tying yourself into future expectations about the economy and about what the market favors at the moment, as opposed to tying your future retirement fund to proven profitable businesses that pay dividends. And so those are two separate approaches. Some people say one is better than the other. I personally subscribe to the dividend approach, but again, a lot of respectable people think that the other approach is better. And so you just have to decide what's best for you. But in today's video, I'm going to talk about that second approach, and that if I were to, instead of picking and actively managing a portfolio of individual stocks, which is what I personally do at High Yield Investor, and that's how I achieve outsized total returns over time and outsized income yields over time. If I was not as concerned about that, and I simply just wanted a very simple approach, just a nice diversified portfolio of, say, 4 funds that I can just put on relative set it and forget it. Again, not complete set it and forget it, some rebalancing, monitoring these funds and make sure that they're doing what's right, but much less involved than, say, investing in individual stocks. And sure, I would do this knowing I'm giving up some total return potential for sure, but again, if I was to take that approach, because I know some of you guys out there don't necessarily have time or desire to study individual stocks and actively manage your portfolio all the time. So what are these 4 funds I would pick? If I could only pick 4, what would they be? And that's what I'm going to talk about in today's video. Before I get into it though, if you like receiving regular dividend content, whether it be some of my individual top stock picks of the moment, which I share regularly in videos, or some of my favorite funds like I'm going to talk about in this video, please give this video a like to help it get broader distribution, help me grow my channel. It's just a small way of compensating me for my time to put together this free video for you. And then also, if you could subscribe to my channel, you can get all my future content. That would mean a lot to me. Thank you very much. Okay, so what is the first fund? Well, this shouldn't be a surprise to you. It's quite popular on YouTube, quite popular in my videos because it's a great fund. The Schwab US Dividend Equity ETF. That's ticker symbol SCHD. And there are a lot of reasons to like it. One is the very low expense ratio, which is 0.06%, making it one of the lowest cost funds out there. It's broadly diversified across over 100 blue chip dividend growth stocks. It has a dividend yield of around 4% right now, which again is, well, there you go. You got the 4% rule, but instead of living off the 4% rule of selling shares, which is much riskier, you can simply just live off the 4% dividend yield that this fund pays out. And in fact, it has a history of growing its dividend at a very rapid pace over the past decade. It's grown its dividend at an 11% average annualized rate. That significantly outpaces inflation over that period of time. And so your real purchasing power has actually significantly increased over the past decade if you've been holding SCHD over that period of time. And so that's a big plus to the fund. Additionally, its long-term total returns have been pretty solid. Of course, if you're going to be generating that sort of dividend growth alongside a solid yield, you're going to get pretty good returns. Sure, in recent years, it's been a bit of a dog. It's lagged the stock market, the S&P 500, but that's because it doesn't have exposure to mega cap technology stocks. And so since those have been really winning big in recent years because of the AI boom and the market's bullishness on that, SCHD has been left behind. But over that period, the dividend has continued to be paid, continued to grow at an impressive clip year after year after year. So if you're just living off dividends from it, who cares? In fact, that's nice because then you can buy more at a cheaper price than you would have been able to otherwise. But in the years preceding that, it has a good long-term track record of giving you regular, steady appreciation, as well as these consistent and growing dividend payments. So that's why it's the first fund that I would pick in this list. The second fund that I would pick is the Reeves Utility Income CEF, and that's ticker symbol UTG. It's a CEF, not an ETF, and what that means is that there's a fixed number of shares, and the price that you pay for it can fluctuate relative to the underlying value of what it holds or the net asset value. This contrasts with ETFs like SCHD, which the price you pay for it in the stock market is roughly very, very closely tied, basically the same as the total value of the underlying holdings that it has, the individual stocks. And so when you buy CEFs like UTG, you want to look and make sure you're not paying an abnormally high premium to the net asset value. And that's one of the reasons I like UTG. It pretty much always trades pretty much very close in line to its net asset value. So it's almost like an ETF in effect of how it actually trades. And so as long as you're not paying a big premium to NAV, I think UTG is worth holding. It has a dividend yield of near 7%. And so it's a pretty attractive yield, much higher than SCHD's. It pays out monthly dividends, which is another thing that a lot of retirees like because it aligns better with their monthly expenses, and so therefore they're better able to manage that with budgeting and all, although it really doesn't matter, but some people like that as a perk. I also really like UTG because it has actually a pretty reasonable expense ratio for an actively managed fund, especially when you don't count the interest expense on its leverage. It's not that high compared to even some actively managed ETFs, and so you're not bleeding a lot in fees to the management. I also like that the leverage ratio is quite prudent. It's low enough that it's not going to cause a lot of risk that in the event of a market crash, you might get a margin call and have to lock in some permanent losses and suffer a dividend cut. That's not a big risk with UTG. In fact, its track record is very impressive since before the great financial crisis. It is not only sustained, but it's actually grown its dividend quite significantly over that period of time. So it's been a very stable, dependable dividend payer and even a dividend grower over time, which is exactly what we're looking for in this kind of portfolio. And last but not least, UTG is also significantly outperformed over the long term relative to its broader utilities sector. And so you have an active management there in this fund that has proven to be very good at what it does. And so you're getting that too, which is great. I also really like that UTG, again, is focused primarily on utility stocks as well as some other infrastructure companies. And that gives you nice diversification since SCHD does not own much in the way of utilities or infrastructure. And so it adds more diversification to the portfolio. And utilities and infrastructure happen to be among the most defensive sectors in the entire market. And so that sets you up for a fund that should be able to pay its dividend fairly consistently through all sorts of economic environments, as has been evidenced by its past track record. Okay, so what's the third fund that I would pick? Well, another fund that I like a lot is somewhat similar to UTG, but it is different as well. It's the Global X MLP ETF, and that's ticker symbol MLPA. And that focuses specifically on energy infrastructure, especially midstream infrastructure. And so it complements UTG nicely, has a similar dividend yield. Actually, it's a little bit higher. It's about 7.3% right now. has a pretty low expense ratio of just 0.45%, which it compares very nicely compared to another MLP ETF like the Illyrian MLP ETF, which has a 0.85% expense ratio, so much higher than MLPA's. And you have some of these actively managed CEFs in the midstream space that have expense ratios of over 1%. So MLPA is much cheaper than those, and that gives it a leg up in my view. It also has good underlying holdings like Enterprise Products Partners, Energy Transfer, MPLX, Western Midstream, Plains All American Pipeline, and so on. These are all blue chip MLPs that have strong investment grade balance sheets, very attractive distribution yields as evidenced by the yield paid by the fund, but also strong distribution growth outlooks. And so I think MLPA, it's grown its distribution at a high single-digit pace in recent years, and I expect it to continue doing that moving forward, or at least at a mid-single-digits pace. So not only does it pay a high yield, but its yield should grow faster than inflation for the foreseeable future. Another thing you really like about MLPA is that while its underlying holdings all issue K1 tax forms because they're MLPs, with MLPA you don't have to worry about that. The fund handles that for you and just issues a 1099 that you'd get through your broker, aggregated probably across all your holdings. And so that makes the tax implications much simpler for you if you don't like it, or if you want to hold it in an IRA or a 401k, it's much more suitable than a K1 would be for that. And so that's another big positive with investing in a fund like MLPA. Now the fourth fund is going to be a REIT preferred ETF. It's the Virtue InfraCap REIT preferred ETF. It's ticker symbol PFFR. Now some people say, okay, why would you invest in that fund? Okay, it yields, I think, a little bit under 8% at the moment. It has around a 0.45% expense ratio. Okay, that's nice, but you don't really get much growth. It has had relatively weak performance since going public, at least compared to the S&P 500. And so people are like, what a waste. Why would you do that? Well, you have to understand this pick in context. First of all, this is a retirement dividend income portfolio. You're looking for a diversified basket of holdings that can pay you attractive and sustainable income through your retirement. And so PFFR checks those boxes. It's got a very attractive yield. It pays monthly, just like UTG does, and it rounds out the portfolio nicely. SCHD gives you nice broad diversification but lacks much exposure to real assets or fixed income. UTG and MLPA make up the lack of exposure to utilities and infrastructure with their emphasis. And then SCHD also does not have much exposure to real estate, and so PFFR gives you that, but also gives you exposure to fixed income, which is generally much more defensive, especially a real estate backed preferred ETF that's diversified across many holdings. Really does give you that nice diversification and even a sense of safety because of that real asset component, the preferred position in the capital stack, the fixed component of the income that has to be paid out before any dividends are paid out on those REITs. And so that really gives PFFR a leg up. And as for the weak performance, well, that's to be expected. It's a fixed income ETF, so it's like bond-like in nature. Interest rates have risen a lot over the last several years, really since PFFR has gone public, it's gone up a lot. And so that, of course, is going to weigh on the stock. And it's not because dividends have been cut. It keeps paying out that nice stable dividend month after month, even through the COVID crash, etc. And yes, its stock prices come down, but so have treasury bonds. Does that make treasury bonds a high-risk investment? Of course not. Now, of course, there are risks to consider with long-term treasuries, which is interest rates, inflation, etc. And the same is present with PFFR, but it's part, again, of a diversified portfolio, whereas MLPA, UTG, those are more inflation-resistant investments, as infrastructure tends to be. SCHD grows its dividend faster than inflation over time historically, so that helps to insulate you from that. But PFFR gives you that high yield, that defensive stability, and that diversification that helps to round out the portfolio as a whole. So, again, it's kind of like saying, oh, well, why would you have a catcher play if he's a bad hitter? Well, you need a catcher to play the field. That's an essential part of your lineup. And so it's the same with PFFR. It just rounds out your portfolio better, gives you that diversification and that nice sustainable yield. So there you have it. If I had to put a portfolio together of just 4 funds that can pay out a high sustainable yield to give me a nice stream of income in retirement, and it was one that I was not planning on really actively managing super aggressively. Sure, I'm not going to go to sleep on this portfolio, but I don't have to be watching it every day or even every month or even every quarter. It's something I'm going to watch, maybe once or twice a year if I need to do some rebalancing. Maybe macro conditions have gotten such that I'm just really concerned about the real estate sector, so maybe I want to move out of PFFR, or maybe the utilities or midstream industries are facing some existential threat, or maybe SHD gets reconstituted to some weird index and I don't like it anymore, or I find a fund that I like better, whatever, that's fine. But again, this is not a portfolio I have to really closely manage. So again, if you like this content, please give it a like, subscribe to my channel to get more ideas like this in the future. Thank you very much. See you next time.